Okay, well, thank you. And Maninder, thank you so much for joining us today. I think the audience is always interested in the perspective of investors. It helps them sort of understand what's on the other side of the table when they're in asking for money. So welcome and thanks for your time. And also, given your broad network, I think you're going to really have some interesting perspective for our audience on, what the current state of the art is on the investor. I call it the buy side. And so we'll do a little bit of role playing. I'll play the sell side and you can play the buy side. And maybe just to kick things off, I was very surprised, but the Canadian Venture Capital Association announced that this past quarter, so that would be Q2, was the most active investment quarter in their history. So deals are getting done. So for those entrepreneurs listening in, it's not as bleak as you might think out there. There is actually money being invested and investors excited about hearing your story. And maybe the first question to you, Maninder, is we've heard people talk about the K-shaped recovery. So back in March, when the world came to a close, everything went south. And then as time marched on, there became sort of winners and losers. If your business counted on people in crowds, like let's say in transportation, for example, you suffered mightily. On the other hand, if your business supported, say, working from home, man, you're on fire. So I'm very curious, Maninder, is that what you're seeing out there in terms of deals? Are you seeing investors really bifurcate and there's the haves and have-nots out there?
Absolutely. Thank you. I did want to say, first of all, that if I knew that Tiffany had to read my entire bio, I would have gone with a much shorter one. So sorry about that. Yes, the point you're making, Peter, is absolutely correct. So there are haves and have-nots. And even though more money is exchanging hands, that divide is being reinforced. And I actually have never seen it this strong. So if you have a business that is fundable, and I think a previous speaker made a point, like, do you have a business that is fundable, which is, I would say, venture-backed. And a lot of the businesses are not, and mainly because you actually don't need money to scale. So that's the first decision. So businesses that are fundable, good fundamentals, they need the money and they're happy to raise the money, we are getting term sheets faster than we ever have, and bigger. So more money is being offered. And then the have-nots is, these are the projects where I would say one of the things are missing. Either the business case is not strong enough, or it is, but it's not clearly articulated. You don't have a clear path to capital allocation. What are you going to do in the next 12 to 18 months with this money? Those ones, actually, the no's are coming faster than ever before as well. So this is definitely a K-shaped, even in the investment world.
Okay, thanks, Maninder. And then maybe just to keep up the theme of letters in the alphabet, investors are always looking down the road because you're really investing in the future. So you're trying to guess the future. And I guess my question to you is, do you see the K being followed by an X? And what I mean by an X is you've got a company that's on fire somewhat artificially because we're all stuck at home. And are investors looking past this period to imagine what a post-COVID-19 world looks like? And is your business going to sort of maybe come back down to earth? So that would be one part of the X. But the other part of the X is, say you've got what should be a good business in normal times. I don't know, let's say you're a supplier to the entertainment industry or the travel industry. You've got a great product, you've got a good, strong value proposition, but your customers are on their knees. They won't buy anything. But time passes, things return to normal, and that business should be investable and exciting down the road. And of course, investors always want to sort of invest ahead of, what do they say? They invest on rumor and sell on fact. So I guess my question to you is, do you see this K followed by an X of some sort?
Well, I see, I think that's a great question. The way investors see it, the way I would see it, there are macro trends and there are micro trends. So macro trends are always going to stay. And I'm working with a clean tech project, which is R&D, that we know climate change is the next wave, or it's happening. So those will continue. A lot of the things will go back to where they were, and a lot of things were not. Customers who are shopping online, they will start shopping in stores again, but they will not give up the online factor. People, online banking, online signatures. Like yourself, I have some background in working with the government. And remote meetings was an absolute no-no until March, like not going to happen. You have to come to Ottawa for every single meeting. That's set in stone and that's the way it is. And now the meetings are happening online and they are productive, they are effective. So I don't think we're going back to the way the world was. Some things have changed and they will stay changed. And some things will come back to, as the restaurants open again, as the transportation picks up again, they will come back. But when you're looking at that, if as an investor, we're looking at 12 to 18 month runway. And 12 to 18 months, we expect things to stay quite similar to where they are right now. But R&D projects, they have a 5 to 6 year runway that you look at macro trends. So I would say the answer to your question is both yes and no.
Thanks, Maninder. That's excellent. And I think that's really helpful to reinforce to our audience that what you're hearing is they expect this, let's call it this topsy-turvy world for in the sort of 9 to 18 month time frame, and it won't necessarily go back to normal. It won't go, I don't want to call it normal, there'll be a new normal, but it won't go back to the way it was. So thanks for that. So then maybe, and by the way, Tiffany, if there's questions from the audience, I would love to, pose those to Maninder. In the meantime, I'll keep pestering her with my questions. So for any of you listening in, please feel free to share some questions. So Maninder, maybe another question is, at least from your perspective, what are your areas of interest? What do you think is an attractive space these days for investors? For example, last year, maybe it was AI. God, if you had any kind of AI company, investors were knocking at your door. What can you pass on to our audience as to, what's getting attention these days?
Well, in industry, we have what I would call sophisticated investors, and then there are people with money. And so there are two different kinds, and there are always trends that do matter. I mean, 2 years ago, cannabis was huge. But if you're an entrepreneur completing a round, you need to be in a sweet spot where the sophisticated investors get you and are willing to lead the round, but other people are happy to write a check because you're on trend. You are on what they read in the newspapers. So I would say where the things that are long-term, where we see a lot of projects in clean tech is huge. People are getting the point that the world is going to change. Even the ones who weren't getting it before, they're getting it now. So clean tech is huge. Anything direct-to-consumer brands, a lot of these are large companies used to own, I won't name any names, but they used to own brands, and all the food was created more for shelf life rather than for nutrition. And that is a trend that people are picking up. And it's not just young people, the millennials, the Zoomers, everybody else is figuring out, okay, food needs to be better quality than something that can sit on a shelf for 2 years and it's still good to eat. So that is a trend we're seeing, is high quality food with actual scientifically backed, why is it good for you? The working from home, cybersecurity, and working from home brings a lot of different things that are different. So people are using their own computers. So cybersecurity, we're seeing a lot of that, especially in SaaS. Anything that's remote, and we see the world as there will be a combination from working from home and working remotely. Working from home and working from the office. There will be a mix going forward. So anything that helps people collaborate better is on trend. So those are a few things that I'm seeing, and they're all over the place, but eventually what is, as an entrepreneur, it's your job to convince the investor that there's a massive addressable market. And this is the right time to do what you're doing. And some people may have done this before, it didn't work, why would it work for you? And that the burden for that is always on the entrepreneur to show the investors.
Thanks, Maninder. Great answer. So maybe shifting a little bit to investor syndicates. So you had mentioned lead investors. I'm curious as to whether you've seen the mix of say, deal size or investor syndicate members change? Historically, there may be a lead investor, which is typically a venture capitalist that will do all the due diligence and set the terms of the deal, but oftentimes joined by strategic investors, corporate investors to fill out a round. I'm just wondering if you're seeing any changes out there with COVID-19 in terms of investor syndicates.
Yes. So when we're talking about funding, so there are two distinct layers, and they do get mixed up. So it's really different, but distinct layers is the first level is angel investing. And this is where the first time you go raise outside money. So entrepreneurs would fund the project themselves. There'd be friends and family, these people you know. And first time you go to raise money from outsiders, these are angels. And these are people who invest their own money. There are some seed funds that encroach on the angel territory, but mostly it is individuals, and those syndicates are angel groups. I am a member of 3 of them in British Columbia, and they are all, they're even within the syndicates, there are people, like if somebody's writing a check, they will email me and I will match them because we work together and I trust their judgment. So that is, when you're going to a pre-Series A or a Series A, at that time, the dollar amount is much higher than what individuals can do. And there are exceptions, but mostly these would be funds. And funds are people managing and investing somebody else's money. The principle is the same. You get one lead to believe in the product, the first person to be willing to write a check. And then these are concentric circles. The first one, I'm willing to write a check. I support an entrepreneur. I go to 50 people that I worked with in the past and say, hey, this is a great project. This is how much I'm willing to put in. This is remaining. Does anybody want to come in with us? And then after that, we'll move one level out. And these are the angels I know, but maybe not worked with. And then we'll move outwards till the round is complete. And that happens at the higher level as well. But funds will do this and not individuals. With the changes that I'm seeing, some of the things that I'm noticing is because we are home. So I used to split my time between San Francisco, Mumbai, and here, and everything was mobile. Now it's highly geographically focused. So projects that I'm seeing from all over the world, but even though it is remote and you think, oh, I can talk to anybody in the world, anywhere, but the existing relationships have started to matter more than they did. So if I needed to talk to an investor in New York, I'll just fly out there with the entrepreneur, we'll have a conversation. So geographically, I am spending more and more time with my 3 angel groups in BC than I'm doing with my remote connections. So being in the same geography shouldn't matter because we are remote, but I'm finding that when it comes to writing a check, it's starting to matter more.
That's a great comment, because I've always said that due diligence is a full contact sport. And if you can't travel, it's difficult and challenging to do that. So thanks, Maninder. That's very helpful. I want to maybe, and by the way, just a shout out to the audience. Don't be shy. If you've got questions for Maninder, please send them my way. I can read them and I can ask Maninder. So Maninder, maybe a question on fund economics for for basically those entrepreneurs out there that maybe haven't done an A round before. So if you can talk through, I'm a VC, I'm raising a round, maybe it's $100 million. And by the way, this is just to give them a sense of how VCs think about valuation, how they think about portfolio values. Gee, why? Because I know my company is going to be a complete home run, why are they valuing it like it's going to be a single, or a double? And so maybe you could talk to the portfolio and how VCs kind of come at the reality, which is not every investment works out, and therefore I need my winners to really win big in order to have a return.
Well, when it comes to fund economics, and angels are more or less the same, even though it's their own individual money. On average, 9 out of the 10 investments do not work out. And when I say do not work out, they could be alive for 7 to 10 years, but we're not getting our money back. So 1 out of the 10 will pay back, and the timing depends. In San Francisco, it's much faster. In India, it's much slower. But if I'm writing 10 checks, I know that 9 of them will not work out, will not come back. But the 1 will pay for those 9 plus extra. And that's the math. And at the fund level, that's also the math as well. When you're looking at funds, so the numbers that I'm going to mention are based on my experience. So that is the caveat here. It is a multiple of revenue. and you will get anything between 4 to 20 times the revenue. And why the range? A lot of it is individual opinion of the person writing a check. If you are a project that's on trend, you will get 20 times the multiple. If you're a project on trend in San Francisco, you'll definitely get the multiple because there's more money at play there. And so if all things are in place, $1 million ARR will get you a $20 million valuation. Any of the pieces are missing, that number will come down, and it could be as much as 2 to 3 times of what your revenue is, what they think the company's worth. And the other thing that fund managers will look at, they ideally want to own at least 20% of the company. So at any round, this is the tug of war. At 30% dilution is too much, even at the angel round, 30 is too much. 20 for the entrepreneur, you want to stick between 12 to 15. The fund guys will settle for 20. If it's 30, then you better have a plan. And sometimes, you have a engine and it just needs more fuel. Then you will raise money because you will make up the difference in the next round. So if it's 30, you better have a plan and you better articulate it to the investors. So those are calculations. They're complex. It will depend upon, are you a B2B company? Are you a B2C? Are you a complex R&D? So it's hard to answer it generally, but what I can say is whatever your revenue is, it's 4 to 20 times, provided you are a fit within what the entrepreneurs want to invest in. If you have $1 million in revenue, doesn't mean you can go to any investor and they will at least give you the company's worth $4 million. If everything is in place, even then there is a range. So if you're an entrepreneur raising money, make sure you have everything that you can do on your deck, have it on your deck. If there's a partnership that will make your company worth more, make sure that conversation already starts before you start raising money, because you will get cheaper capital and a much better deal. So sorry, I hope I answered that. It's really difficult to be definitive about that.
Yeah, I think you did, Maninder, and thanks for that. I mean, I guess I want to make sure that the entrepreneurs listening right now aren't taking their spreadsheets and typing in revenue times 20. And good news, Maninder says this is my value, because like you said, Maninder, that number is sort of priced to perfection. You have got to have sticky customers, low cost to acquire customers, sort of revenue upside with customers over time. I mean, really everything has to be perfectly placed. And, the reality is companies wouldn't have that. But thanks for that. And again, that was primarily for a sort of a SaaS business model. For companies that are making hardware or maybe don't have recurring revenue, obviously there's different valuation metrics. But by the way, we're now getting some questions from the audience. So here's a question from Gary, and this is for a SaaS company. We're SaaS companies supplying trucking industries. My question is this an active area for investors for trucking companies? So that's transportation, which maybe if everything's now at home, maybe that's a happy time for transportation companies. So anyways, Maninder, any thoughts there?
Yes, I mean, transportation, there's a couple of things that I'm seeing that are hot in the sector. So last mile delivery, even with Amazon, last mile delivery is going to be done by a truck or somebody driving something, bringing stuff to your home. So this is what I would call an evergreen area. It will always be required. The parts where I'm seeing activity in the transportation, using AI to save fuel, electric charging, is where we're seeing activity in how to optimize load. So it's basically saving energy, saving costs, and green. Those are a couple of things where I'm seeing things in transportation. And it all depends what you're providing. If you are providing billing and it's an archaic manual system, you're automating it. You just have to show that, the point that I like to make is either you are a painkiller or you are a nutritional supplement. If you are a product that is a painkiller for the industry, that they have to have it now, it makes sense on day one, then you are in good shape, no matter what your industry is. If you are making something non-urgent better, then it's a slightly lower number. But I would have to see what exactly you do for the industry to answer that specifically.
Okay, thanks, Maninder. Another question from the audience. So we were talking about valuation as a multiple of revenue, but what if you're early stage, you don't have any revenue and you still need money? Well, how do you come at valuation then?
That is a really, really good question. So yes, so if you don't have revenue, what I would say is you have to convince investors the company is worth that much. And the example that I would like to use is, a project. It's an ag tech project. It will revolutionize the way carbon is captured in the soil during agriculture. So the way we are for making it, like, in order to raise money, we have to convince investors this is a $100 million company. And a couple of things to convince investors is, first of all, you're solving a real problem. It is the problem actually exists. This is how much money would be saved by using your product. And make sure, even if you don't have the product, there's testimonials from people who are willing to buy it. And if you can't have the product, you can't ship it, make sure at least you get letters of intent from customers saying that they will buy it if this exists because this is a real problem. Second way to make these pre-product, pre-revenue companies credible is to have a good advisory board. So a lot of it, people think us investors, we have a lot of spare time, and you do a lot of due diligence, but a lot of it is you look at who else is in, and it's a lazy way of doing it. But with the number of deals that we have to look through, you base a lot on credibility of other people. So you need to have an advisory board where people who understand your industry are willing to lend you their name. That helps a lot. And this could be if in our ag tech company, we have a professor from Stanford that specializes in specifically that thing, and one of the best experts in the world. He's willing to come on the advisory board and say, okay, this, and then investors like, okay, this is a real problem, because if I'm a fund manager in New York, I don't know enough about ag tech, but I can read this guy's bio. I know how many white papers he's written. He's a published author. If he's willing to put his name to it, it must be good. So pre-revenue, pre-product, you have to use other ways of convincing the investor that you are a good bet.
Thanks for that, Maninder. Maybe a follow-on for that, because you mentioned customer testimonials. If you're pre-revenue, if you're post-revenue, fine. You just call up the customers and say what you think, and you can look at revenue traction. But with your pre-revenue, let's do some role-playing. I've got a solution. I think you're a natural fit. I come to you, Maninder, and ask for one of these support letters. How, in your experience, how detailed do these support letters have to be? So, for example, and it could be, hey, Peter, it was good talking to you. Gee, it looks like you're solving a pain point I have. I'm looking forward to re-engaging when you're ready to go to market. Okay, so that would be one extreme. And the other extreme is, oh, Peter, I'm over the moon. I've got this pain point right now. It's costing me X. I'm looking forward to spending Y. And so I'm hoping that we can do a deal in January. So one is, this sort of spectrum of softness versus firmness for those support letters. Just curious to, where our entrepreneurs should try to get to.
Well, second is always better. Second is absolutely always better, especially when you can have numbers around, we will buy 10,000 units at approximately this much price. That is the best. That is absolutely the best. You do want soft testimonials. I saw a project recently from New York, and they had a copy paste of an email from Elon Musk, and Elon was like, great, good for you guys. And so it depends upon who is it from. And I have to tell you, in a room full of people, that's all investors talked about. Oh my God, this guy knows Elon Musk. So it depends, but I would say, and if you could get Elon to write you a letter in detail that he would buy this much, you're golden.
Got it. Thank you. So let's talk about competition, and how do you as an investor evaluate competition? So I'm coming in, I'm telling you my story, I've got these testimonials, you're saying, gee, it sounds pretty good. I wonder, who else is out there? What do you expect from an entrepreneur, first of all, in their pitch deck on the competition, and then how do you, in your due diligence, start to validate those things?
Well, it depends. So when you say competition, and people say, oh, somebody else is doing this already, that is actually not a bad thing. That means that, there is there is money to be made in the market. The problem actually exists. And, so you don't have to come up with a brand new idea. And somebody says, sometimes there's a reason that the road less traveled is less traveled. So if nobody is doing anything in a sector, maybe there's a reason not to do it. So competition that way is not an issue, as long as the entrepreneur can prove what is your secret sauce. And if you are a number 2 player in the market, the other guys, they will just acquire you, which is good news for the investor. So that is not an issue. Where it does matter is you have to convince that, so actually when it comes to, preparing a pitch deck, I have a formula that I'm happy to share with the audience if there is of interest. So it's a PDF as to how the pitch deck should be sequenced. And if Tiffany and Gurvinder, if there's any interest, I'm happy to email that to you. It's open source and you can share it with the audience if there is interest. And this is what are the multiple things that you need in a deck. And this is that's how we evaluate at TiE Angels. That's how we evaluate when I invest some friends of mine. But these are the pieces that need to be in a presentation. So sorry, Peter, I lost track of your question. You may have to.
I'm preparing my pitch deck. The investor is going to ask about the competition. I want to basically explain why I'm better than the other guy.
Yes,
and maybe a little bit more detail, Maninder, because I'm on the buy side as well, and so oftentimes I see what I call the matrix slide. So yes. Down the side are a bunch of features and capabilities of this offering that I've got, and across the top is the competition. And then, not surprisingly, mine has got all green ticks, and all the other ones have got some red X's and the odd green tick, and basically it looks like they're a bunch of losers, and I'm a winner. And as a investor, I really get tired of those charts because, gee, is that function really that important that you've got a tick and somebody, how? Maybe you can just help our audience understand what you look for in the competition slide.
That's a really good point. That competitor slide, that seems to be, it doesn't die. It's been going on for 20 years, and every slide deck has it. Well, the way I see the competition slide is, yes, you're going to show all green ticks. And it does matter, Peter, like you said, if you explain as to the features you have and the other people don't have, especially if you can provide a customer testimonial as to why this one is better. That helps. The other thing, the main point of the competitor slide, the way I see it, and it has morphed over since it started about 2 decades ago. The competitor slide shows that you're aware of who else is in the sector, who else is creating this product, and you'd be surprised how many entrepreneurs are just building something without knowing who else is doing it, what else they're doing. But I wouldn't put, too much focus on the competitor slide as an investor. There is other people doing this. We kind of know that. If you can convince people that you can do it better, faster, cheaper, and therefore grow, it's kind of okay. And as we say, we're willing to write off 9 out of 10 investments, so we're going for home runs. We are going for moonshots. And that means every investment we put in, the upside needs to be massive. The downside is there. We all know that. But if you can convince people of the massive upside, I think the rest of it doesn't really matter.
Thanks for that, Maninder. I would also reinforce your point is that this model where 9 out of 10 don't work out really requires that 1 out of 10 to be a monster. And of course, you really don't know ahead of time which is going to be the one. So you need those big home run stories. And I do think it's important that entrepreneurs understand that, gee, well, look at my story. How could you not like this story? And it could be that it's just, frankly, the market's not big enough. And as a result, the economics don't work. So here's a question from the audience. And by the way, we've got about 4 minutes here. And I would, Maninder, like you to save maybe 1 minute at the end just to bring up something that you wanted that I haven't asked or we haven't asked and yet just drives you nuts about entrepreneurs when they're coming for money. So here's one that I've heard it described a little bit differently. So an entrepreneur is looking at a suite of, an investor is looking at a suite of opportunities. Some have what they call a grade A entrepreneur with a grade B idea, and others have a grade B entrepreneur with a grade A idea. Of course, you'd like to have both grade A's, but maybe, Maninder, you could talk about how much emphasis you put on the person versus the idea.
Oh, 100% on the person. If person is not right, the rest doesn't matter.
Okay, so that's excellent. Remember that. And maybe another way that, that I've kind of described that is usually, entrepreneurs find a way. And the future really never unfolds the way that business plan and that deck that you've got and spent so much time on. You get hit from the side, from up, down, sideways, and you've got to be able to be nimble and react. So that's a
really good point. One of the biggest successes I had as an investor, there were 7 pivots involved over 3 years.
Yeah.
So, but they kept, and so the entrepreneur, his thing was he had background experience and he learned from every time something happened. He learned. If you could show that, I mean, nobody knows everything. Innovation is messy business. Anybody who's able to make predictions, somebody says, seek the company of the people who are looking for the truth and run away from the ones who found it. And I think it's true for ideology, it's true for startup as well. You don't know. The market plan, first interaction with the customer, 90% of the market plans don't mean anything. So yes, and it's not, a lot of it is entrepreneur with previous experience, but if you are new, you're young, don't be disheartened. If you can show that you learned and you learn well, being young is an amazing thing, but it is all focused on your ability to stick with it, your ability to go through 7 pivots in 3 years. And that is what investors want to see.
Okay, well, that's very inspirational. Thank you. And we are almost out of time, Tiffany. So I think, Maninder, I'd like to just give you sort of the final word. Pass on some words of wisdom to our audience.
Wow, I would say this is mostly British Columbia audience, right?
I believe so, yes.
So one of the things about BC entrepreneurs, first thing I would say, have faith in yourself. The entrepreneurs are too humble. If you worked 3-4 years on an idea, you know more about it than anybody else. Take credit for it. Like, you do know what you're talking about. The third point that I would make for British Columbia entrepreneurs is where BC entrepreneurs fall flat is you don't have the networks. And I find it's extremely, I won't use the word irritating. I'm disappointed, and this is what we want to change with TiE Angels. And if you look at the entrepreneurs who are getting funded, they all have some type of track record. They were on the C-suite of something that was big a couple of years ago. So if you're an entrepreneur who wasn't on the C-suite seat at the table at a venture funded company, make sure you network, you go to events, and start socializing your project long before you're ready to raise money. Ask for advice on your deck. Get the feedback, get to know people, go to a lot of pitch competitions, maybe 6 to 12 months before you're actually raising money. So that's what I would say for the BC entrepreneurs. Network, network, network. Everything is global. You can join in a free event in Palo Alto, a free event in New York, free event in London. Do that. And, I'm working exclusively on BC projects since March, and I'm impressed by the quality of both entrepreneurs and the projects.
Well, that's great to hear. Great, maybe audience or a great statement to leave with. So, Tiffany, I don't know if you're listening in or how you jump in here or how we switch over to the next part of the day. But just again, Maninder, thank you so much for your time. I'm sure the audience really appreciated it. It's nothing like hearing directly from people who are writing checks on what they're looking for. So thank you.
Thank you for having me. This was fun.